Everyone will be chasing the next craze in 2026, hustling for quick wins, speculating on new coins, trading sleep for side gigs. Meanwhile, a quieter group is using systems and skill leverage to build lasting wealth. Last year, one micro-SaaS reached $31,000 in monthly revenue in just 4 months, but that barely made headlines. If this kind of clear, practical money thinking helps you, like the video and subscribe to Money Explained. The real paths to getting rich in 2026 are almost invisible, and that is exactly the point. Alex spent the first week of January reviewing his own resume, not for job hunting, but to inventory leverage. In 2026, specialized skills do not just earn higher rates, they open doors to asymmetric returns. A decade ago, a product manager or engineer might have settled for a promotion. Now, the same skill can be packaged as a digital asset, licensed to dozens of teams, or exchanged for equity in a fast-growing startup. The premium for automation, artificial intelligence integration, or niche technical knowledge has never been higher. According to recent market data, the top quartile of automation specialists command rates 40% above their peers, and roles offering equity or intellectual property participation have outperformed traditional salaries by a wide margin. Alex's audit began with a simple checklist. Which of his skills could be separated from his day job? Which ones produced results others would pay for? Over 90 days, he catalogued an internal workflow tool he had built, originally a time saver for his own team. He drafted a pitch to license it, outlining 3 possible paths. First, retain ownership and license to multiple clients. Second, negotiate partial equity with a startup needing the same tool. Third, convert the codebase into a standalone product for recurring revenue. The difference between hustle and positioning is leverage. Trading hours for dollars has a ceiling, but a single, well-placed skill, especially one that can be automated, licensed, or scaled, can generate outsized returns with less input. In 2026, the first step is not working harder, it is auditing your own leverage. Alex's 90-day skill review set the stage for building systems that earn while he sleeps. Alex pushed the workflow tool live, but this time as a subscription. Instead of one-time sales, every new customer started with an automated onboarding flow. No calls, no demos, no manual setup. The system handled sign-ups, billing, and even the first round of customer support. In the first quarter, Sketch Logo AI crossed $31,000 in monthly recurring revenue. Most of that revenue stayed in the business, with gross margins between 70% and 90%, a far cry from the thin profits of consulting or retail. Automation changed the shape of Alex's week. He spent less time troubleshooting and more time refining the product. With each update, the onboarding sequence improved, guiding users from trial to paid plan without intervention. Churn, the percentage of customers who cancel each month, became the single number he watched most closely. High churn meant leaky revenue, and low churn meant the system was working. To test pricing, Alex introduced 3 subscription tiers. Some clients wanted only the basics, while others paid extra for advanced features and priority support. The system scaled without extra hires, and every new dollar of revenue cost almost nothing to deliver. This was the quiet engine behind modern wealth, systems that earn while you sleep, with discipline around margins and metrics. But as revenue grew, so did the need for protection. Cash flow smoothed the ride, yet the next challenge would be defending that capital from risk and loss. In 2026, interest rates do not just nibble at the edges, they quietly hollow out wealth from the inside. The average credit card APR sits between 15% and 25%. That means a $10,000 balance at 20% racks up $2,000 in interest every year, regardless of market swings or investment returns. By comparison, even a strong year in the stock market might yield 7% before taxes and fees. The numbers do not lie. Paying down high-interest debt is the only guaranteed double-digit return available to most people. Alex faced this reality head-on. Before thinking about where to invest, he listed every liability with its APR. The high cost line, $9,700 at 19.8%, topped the list. Instead of spreading cash across multiple goals, he wiped out the balance in one move, redirecting new revenue from his subscription business. The result was immediate. No more $160 of monthly interest eating away at progress. With the debt gone, Alex set a second target, a liquidity buffer equal to 5 months of essential expenses. He opened a high-yield savings account, automating transfers from each payout. This was not just about peace of mind, it was a runway. If revenue dipped or a client delayed payment, he had time to adjust without panic or forced selling. Every dollar no longer lost to interest became a building block for future growth. The compounding effect works both ways. Unchecked, high APR debt compounds against you. Cleared, it turns into a silent engine for resilience. Only with this foundation did Alex look to the next phase, putting capital to work for long-term gain. Alex set up a monthly transfer from his business account to a low-cost index fund. The process took less than 10 minutes to automate, but the impact would last for decades. Each month, a fixed amount left his account, buying shares regardless of market headlines or economic forecasts. This steady contribution, repeated over years, is the foundation of quiet compounding. Historically, broad equity markets have returned between 7 and 10% a year before inflation. Yet many investors see far less, not because of bad luck, but because of fees and interruptions. A single percentage point in annual fees can shrink a 30-year portfolio by more than 40%. That is the silent drag of high-cost funds and unnecessary turnover. Alex chose funds with fees under 0.1%. He also directed contributions into a tax-advantaged account, ensuring more of each dollar stayed invested and compounding. The real advantage comes from automation. By removing emotion and market timing, Alex avoided the common traps, buying high, selling low, or sitting on the sidelines after a downturn. Every month, the system put his capital to work, quietly accumulating shares and reinvesting dividends. Over time, small, regular contributions add up, especially when untouched by high fees or taxes. Consistency beats excitement. The headlines may spotlight sudden gains or losses, but wealth grows quietly in the background. For Alex, the checklist was simple. Automate contributions, choose low-cost diversified funds, use tax-advantaged accounts, and ignore the noise. The payoff is not visible day to day, but decades of compounding create options that speculation never could. Quarter by quarter, optionality is built in layers, not leaps. The first rung is cash flow, a surplus above essentials that you track month to month. Alex set a strict target. Spending never exceeded 75% of his baseline income. The gap wasn't just saved, it became a tool for flexibility. Each month, he reviewed expenses and trimmed non-essentials, ensuring surplus funds were real, not theoretical. By spring, a secondary income stream was live, freelance technical writing, drawing on skills he'd already leveraged for his product business. The new cash flow wasn't massive, but it didn't need to be. Together, surplus and side revenue covered more than a quarter above core living costs, creating a buffer against shocks or sudden opportunities. This layered approach, surplus first, second income next, set the foundation for every further step toward freedom. Alex closed his laptop on a Thursday afternoon and booked a one-way ticket to Lisbon. There was no employer to notify, no office to return to, and no scramble to line up new clients. The decision came down to a single spreadsheet. With cash flow from subscriptions, freelance writing, and a new slice of income from private credit investments, monthly essentials were covered from 3 continents at once. By diversifying into managed rental properties and private lending platforms, Alex replaced the need for a fixed salary with a portfolio of steady deposits. Rent from a small duplex in Ohio arrived the same day as interest from a peer-to-peer lending note. For the first time, location and profession were choices, not constraints. The freedom to step away for a month or a year did not come from a windfall, but from options quietly built, layered, and protected. In 2026, wealth looks less like a number and more like the power to decide. Wealth in 2026 is less about chasing trends and more about building quiet leverage. As automation and volatility reshape the landscape, people who cultivate systems and flexibility quietly outpace the noise. True prosperity remains understated. In a world obsessed with visibility, sometimes the smartest move is to stay invisible. Thanks for watching.